What's up, everybody? Welcome back to the Stocktrades.ca YouTube channel. My name is Dan Kent, one of the co-founders of Stocktrades.ca. We are one of the largest independent stock research websites in Canada with over 2.5 million visitors in 2020 and approaching over 2 million in 2021 already. So if you're interested in looking at that, head over to www.stocktrades.ca. In this video, we're going to focus primarily on dividend options. I know there is a lot of investors who are hurting right now who went extensively into growth, and now we're getting a ton of feedback via comments on the channel, via email, or even on the website, comments on the website of people who realize that they might have went a little too heavy in the growth department and now they want to diversify into some dividend stocks. So I've got two popular Canadian REITs in this video along with three popular dividend stocks that I'm going to go over, so it is going to be jam-packed. But first, let's go over a little bit of the change of state as to this YouTube channel and something we're doing over at Stocktrades Premium that you can get access to absolutely free. Let's go. So before we get started, head down below, subscribe to the channel, and most importantly, smash that like button. It helps us with the ranking algorithm and getting more views to this video. So before I start with the two REITs and three stocks, I just want to say that we are taking everything exclusive to Stocktrades Premium. And no, you won't have to pay. This is all going to be absolutely free. But we have had requests, because a lot of other YouTubers do it, is that you want early access to articles and videos. So what we're going to be doing is taking all of our research that we make via article or that we put on YouTube, and we are going to take it over to Stocktrades Premium, which you can sign up for absolutely free, and you will gain early access to it. So this doesn't change anything about this channel. We're still going to publish the exact same videos as we typically do, but they're going to go on Premium early so that people can read our articles and videos ad-free, and they also gain access to them a little bit earlier. So if that is something you want to do, just head down below in the description. I have left a link to sign up to Stocktrades Premium, absolutely free. And to go along with the early access content, you're going to gain access to 3 out of our 10 foundational stocks. You're going to gain a 30-day trial to our growth stock screener and our dividend safety screener. And you're also going to be eligible for the largest discounts to upgrade to Stocktrades Premium if you want to. With that being said, let's get started with our 5 dividend stocks, and the first one I am going to speak on right now is more of a dividend growth play, and that is Alimentation Couche-Tard. So what exactly is Couche-Tard, and why are we highlighting it as a top dividend stock when it yields less than 1%? And I'll get to the yield a little bit later, but the company is one of the largest convenience store chains in the world. They sell gasoline, they sell junk food, they sell cigarettes, they sell lottery tickets. They are your typical gas station company, and they operate under some pretty large brands. In the East, you will see often Couche-Tards, and in the West, they don't have too many of them anymore. They've rebranded most all of them, but they used to operate under Max. But right now, their number one brand, and the one that has the most global exposure, I mean, it's in Egypt, it's in China, it's in North America, it's in Europe, and that would be its Circle K brand. This is a massive, massive blue chip Canadian stock. They have a market cap of around $47 billion and had nearly $60 billion in trailing 12-month revenue. So now that we know what the company does, we can focus on the dividend. And at the time of filming this, Couche-Tard yields less than 1%. I believe it's around 0.86% right now. And at the rate this company has been growing its dividend, which is about 23.55% annually over the last 5 years, which pretty much means it's on pace to double its dividend every 4 years, it doesn't really make sense that this company yields so low, right? Well, the only way this can happen is if it is appreciating in share price just as rapidly, and Couche-Tard has done that. In fact, a $10,000 investment in Couche-Tard just a decade ago, if you had reinvested your dividends, is now worth $105,000. That's a tenfold gain on your investment, and it's not like you're buying into some nano cap, small cap stock. This is a large company with a huge global presence. I mean, I know people want a passive income stream via dividends, but at this point, especially with this total appreciation, I really don't care about the dividend. I mean, if I really wanted to, I could just sell off shares to essentially create my own dividend that I can pay myself at any point in time. I'm a massive fan of going for overall returns, and this is exactly why I like Couche-Tard so much as a dividend play. This is a company that has a payout ratio of 9%. They have so much more room to grow the dividend and likely will in the future. The company had a failed acquisition attempt of a French grocer Carrefour, and as a result, that caused its price to dip significantly. In fact, we relayed this out to premium members that in the $36 range, Couche-Tard was practically a no-brainer. Now, it has recovered much of this price back. It's trading just under $44 a share at the time I'm filming this, but there is still pretty solid upside in this stock. And I can't stress enough, if you're a dividend investor that isn't exclusively looking for yield and is willing to take something that can provide outsized total returns, this might be a stock you want to look at. So we've gone over a small yielding total return income option here in Canada, and the next dividend stock I'm going to give you is for those high yield seekers, and that is BCE. They trade under the ticker BCE on the TSX. They are dual listed. They trade down in the US under the exact same ticker, and if we look to the company, this is definitely one of the largest blue chip stocks in Canada, and Canadian telecoms have arguably the biggest economic moat in North America. I mean, with the recent Rogers and Shaw purchase, even though it hasn't gone through yet, it's still awaiting approval. If that were to happen, there is essentially three major players here in Canada, that being TELUS, Rogers, and BCE. And out of those three, do I feel that BCE has the best chance to provide the most overall returns? No, but I know there will be people watching this video that want a high yield option, and BCE is exactly that. It is an absolute dividend beast. In fact, if you had invested $10,000 into the company in the mid 1990s and reinvested the dividends, it looks like $377,700 today. This is an insane investment return over that period. I mean, if you would have went $20,000 into BCE in that time, you'd practically be funding your retirement right now off one stock. So the company is the largest telecommunications firm in the country, and it provides services to over 9.6 million customers. It's pretty much the only big three telecom to have a strong presence from coast to coast. We see Rogers has very strong presence in the east, and TELUS has very strong presence in the west. As I'm filming this, the stock yields around 6.02%, which is above its historical averages. That is primarily because the price has been relatively flat over the last while. This isn't a stock that's going to blow you away with super high growth, but it's going to provide you almost a market return matching dividend. I mean, if we're trying to achieve 8% annual gains, I mean, BCE is providing you with 75% of this just based off its yield. So the company has a 11-year dividend growth streak, and while this might look lower than other telecom options, it's kind of a weird situation because the dividend wasn't cut or halted or anything. It was frozen because of a pending purchase by the Ontario Teachers Plan in 2008. So they froze the dividend. They didn't cut it. They didn't suspend it, but it did stall its dividend growth streak. But if we look to the history of BCE's dividend, we can go back to 1983, in which it has never missed a dividend payment or cut its dividend. So when we look at BCE in terms of payout ratios, it pays 120% of earnings, which is going to scare a lot of investors. But if we look to the free cash flow of this company, which is what you absolutely need to do with a major telecom like this, I'll actually leave a link up above and also in the description to my payout ratio analysis on why the payout ratio in terms of earnings is essentially useless for heavy capex companies like TELUS, like Rogers, like BCE, like Fortis, and why you need to be using free cash flow. it sinks down to 80% of free cash flow, which is still pretty high, but this dividend is well covered. The company, in terms of historical valuations, is neither cheap nor expensive. In fact, it's pretty much trading right in line. And I think it is trading relatively flat over the last while because of the rumors of rising interest rates. This would be poor for telecom companies, but the fact of the matter is, we would need a lot of subsequent interest rate raises before interest rates would really begin to erode these companies' bottom lines. Overall, if you're looking for purely for income, BCE is one of the best options in the country. It is a very reliable blue chip company in one of the strongest industries in the world. Nobody is taking market share from the big three here in Canada. So we've gone over a total return dividend stock in Alimentation, Couche-Tard. We've gone over a pure yield stock, a high yielding stock in BCE. So now I'm going to give you a look at something that could be a little bit of an inflation play, which is Canadian Apartments REIT. They trade under the ticker CAR.UN on the TSX. This is one of the largest residential real estate trusts in the country. You'll often see this REIT referred to as CAP REIT, C-A-P-R-E-I-T. And why CAP REIT in an inflationary environment? Well, the fact is, real estate tends to do very well in an inflationary environment. You do not want to hold companies that are burning cash. You want to hold companies that hold real assets and are generating cash. And real estate tends to perform very well in inflationary environments. So adding a residential real estate trust is a viable option for a lot of Canadian investors. So overall, why are REITs good dividend investments? For one, they're structured in a way to essentially make them tax friendly, that they have to pay back the majority of their earnings to shareholders. In fact, over 90%. So unlike common stocks, this puts a distribution at the highest priority. So what exactly does CAP REIT do? Well, the company primarily engages in the acquisition and leasing of residential properties here in Canada, primarily in the Toronto and Greater Montreal regions. This is where they generate the vast majority of their revenue, and they are primarily a mid-tier to luxury property real estate trust. The company is in one of the best financial positions out of all Canadian REITs, with a debt to gross book value under 40%. Now, most of the industry average will hover around that 50% mark. So this is an excellent debt to gross book value. And the dividend as of right now accounts for less than 75% of funds from operations. Now again, I'll leave a link again to our payout ratio video, but dividend payout ratio in terms of earnings when looking at REITs, absolutely useless. I can't express that enough. It means absolutely nothing. You want to look at funds from operations and adjusted funds from operations, which is exactly what I go over in that payout ratio video. So the company was added to the TSX 60 index last year, and this is an index that tracks the 60 biggest companies in Canada. So in terms of a residential REIT play or just a REIT play overall, CAP REIT is about as blue chip as it gets. So again, at the time of filming, it yields around 2.53%. So this isn't the highest yielding REIT, and there is a lot of investors who are chasing high yielding REITs in the commercial, office, and retail sector. But there is definitely something to be said about distribution cuts. CAP REIT was in absolutely no risk of cutting its distribution during the pandemic, while many retail, commercial, and office options had to cut distributions, which really impacts investors because REITs are held primarily for their distribution, so a cut inevitably hurts more. This is a REIT that has outperformed the TSX index significantly. I mean, you're looking at total returns over the last decade of around 325%, while the TSX has returned around 95%. So it's pretty much tripled the TSX index and is a great option in terms of real estate trusts if you're looking for reliable income. So we went over CAP REIT, which is a blue chip residential REIT play. And now I know that a lot of people are probably itching for a high yielding REIT. So that is one that I'm going to go over next. And it's somewhat of a contrarian play as it is in the office sector, and that is Allied Properties. They trade under the ticker AP.UN on the TSX. So there is absolutely no question that office REITs have been hit significantly by the pandemic and are likely never going to be the same post-pandemic, and that is because the work from home situation in 2020 has caused a lot of companies to realize that they might not need as much office space as they have had in the past. But the need for office space will very much remain. It might just look slightly different moving forward. So although this might be a contrarian play, it is definitely one that you should add to your watch list, because Allied Properties is arguably the best office REIT in the country. And with a 4% yield at the time of filming, it is a mid to high yielding REIT that is going to provide you with consistent returns. So right now, the distribution accounts for around 73.3% of funds from operations and 81.6% of adjusted funds from operations. And these are some of the best coverage ratios in the industry. And it is also an office REIT that raised its dividend in 2020. Now, it wasn't a massive raise. It was only around 3%, but still they raised the dividend, which is absolutely huge. And this is actually the only office REIT in Canada that is a Canadian dividend aristocrat. They hold a 9-year dividend growth streak. And over that time, they've grown the dividend by about 2.5% annually. Again, with a REIT, you're not going to see the massive dividend growth like we see with companies like Alimentation and Couche-Tard growing it at a 23% pace. But essentially, you want to see this distribution trending upwards, outpacing inflation, and its most recent raise of 3% should be able to do just that. The company also has one of the leading debt to gross book value ratios at 31.3%, and it is the second best REIT in terms of interest coverage ratios at 3.3 times. And to top this off, analysts expect some pretty significant revenue growth from Allied moving forward, in fact, 26% on an annual basis. Overall, if you're looking for a higher yielding REIT, one that has more room to recover because of the office space and the inevitability of it rebounding over the next, 1 to 5 years, this is something that you should look at today and add to your watch list. So moving on to our final stock, and it is actually one of my longest term holdings. I have held this stock for a very long time, and that is Fortis. They trade under the ticker FTS, and they are dual listed on both the Canadian and US exchanges. Fortis, in my eyes, is arguably a company that every single Canadian should own. This is not a flashy stock, but this is a stock that you can buy, you can tuck in the back of your portfolio, and it will simply generate income and reasonable returns. I'm not sure I've had to look at a quarterly report for Fortis in a very long time because the company simply does what it has to do. With a beta of 0.05, it indicates that this stock is technically about 1/20th as volatile as the overall markets. I mean, a lot of people say that Fortis practically acts like a bond, but the best part about it is it's not as impacted by interest rates. And what I mean by this is a lot of investors are cautious about Fortis and other utilities right now because of the rising interest rate environment. Much like BCE, rising interest rates would be poor for a company like Fortis. But the fact of the matter is, Fortis's stock price has not been impacted by a rising rate environment. It simply does not react to something like this, and instead it continues to provide outstanding returns for Canadians and is really, in my eyes, a buy at any time option. So what exactly does Fortis do? Well, the company is a regulated utility. 99% of its earnings comes from regulated utilities. So what exactly is a regulated utility? Well, this means that the utility company owns everything up to the meter box. They own the meter box, they own the wires, they own the poles, they own the distribution means. They own everything that gets power to your house. And as such, they can't lose market share. Fortis will go to the municipality. They will discuss a rate that not only guarantees a profit for them, but is also reasonable for the consumer. So it is a win-win situation. This is exactly why Fortis has been able to raise its dividend for 47 years. And they also provide clear-cut dividend growth guidance of 6% through 2024. And this is something that they are consistently able to hit because cash flows are so consistent. So $10,000 invested in Fortis in the mid-1990s is over $250,000 today if you had reinvested your dividends. It is simply an exceptional performer, and at the time of filming this, it yields around 3.68%, so it does have a reasonable dividend yield. This is a stock that is the cornerstone of my portfolio and will continue to be moving forward despite the negative environment that utilities could face in the coming years when interest rates do rise. Companies trading at around 18.5 times forward earnings, Fortis has always commanded a premium in terms of valuation, and this is a price that is essentially right in line with its historical averages. Not only can you lock in a very reasonable and very safe dividend, you could do it at a reasonable valuation. In my opinion, Fortis is and always will be one of the best dividend stocks to own in the country, and too many Canadians avoid it because of its boring business model. So that's pretty much it for the video, everybody. We have 5 more dividend stocks over at Stocktrades.ca. I'll drop a link in the description to our top dividend stock post over on the blog. And again, if you want exclusive content, exclusive articles, and exclusive videos early before anybody else sees them, we're not charging for this. We're not doing anything like that. You can view them and read them ad-free over at Stocktrades Premium, absolutely free. I'll leave a link in the description so you can get started. And with that being said, there will be no video next week on the channel. Instead, it's going to be delayed a week because of this exclusive access. So if you want next week's video, you're going to have to head down below and sign up. This was something that so many people were demanding because they don't want to watch the YouTube ads. They don't want to see the display ads in our articles. So it's something we've decided to launch for you, the readers and the viewers. I own Fortis and I own Couche-Tard. I don't own any of the other ones, but they are still great options for Canadians. And again, smash that like button, head down below, subscribe to the channel, and we'll see you next time.